Welcome to the 2019 World Dairy Expo. And for those of you who are watching around the world, welcome to you as well. This morning's seminar, Dairy Farm Financial Decision Making During Turbulent Times, is being presented by Chris Wolf. My name is Keith Sather, and I'm president of Feed Supervisor in the Supervisor Systems family of products. And we're excited to be a part of this year's World Dairy Expo. And we're really excited to be the sponsor of this important seminar for everybody today. The compounded financial stress of the past few years is wearing on dairy farms, and everyday decisions now are very crucial. And today's seminar by Chris Wolf is going to address some of these issues. As a professor of agriculture economics at Dyson School of Applied Economics and Management at Cornell University, Chris Wolf conducts research and extension training focused on farm business management, dairy markets and policy, farm animal welfare, and animal health management. With his research experience and expert knowledge of agricultural economics, Dr. Wolf will examine the financial decision-making benchmarks for dairy farms, from whole farm to long-term investments to management changes. So this morning, after the presentation, there will be time for questions. So I'll ask you that you hold the questions until then. I'll bring the microphone to you. You also each received a evaluation form when you came in. That's very important that you fill that out for us so that we can continue to make these seminars, better and better. This program today does qualify for ARPAS and your veterinary state board, so make sure that you get that information as well before you leave. With that, I would ask everyone to make sure that their cell phones are silenced, and we'll begin the presentation. Thanks, Chris.
All right. Thanks, Keith. Microphone working well? Everybody can hear me? I'll try not to talk too loud. I'm not used to talking with a microphone. And I usually talk to rooms about this size with undergrads in them, so I'm loud. Good morning, and thanks for coming to this seminar. As Keith said, I'm going to talk about some management decisions, financial benchmarking, some other things like that. The dairy farms, I think, are important. Talk about the situation that we're in. I'm going to cover a lot of different topics that I could talk for a long time on. I didn't used to be long-winded, but I've been in academia now for 22 years, and eventually you can just talk for a long time about lots of different things. So I'll try to keep it moving. I think there's going to be some time for questions at the end, so maybe if you can, hold your questions till then, and so we'll go that way. Normally I would say let's just talk about things as they come up, but I think it would be best for the videotaping purposes and stuff if we saved it till then. Pardon me? Okay, so y'all are dairy industry people, so you're all familiar with this, but let's just talk a little bit about the situation that we've been in this country, and also, it's a similar story in lots of other parts of the world that are major dairy producing, but we're obviously going to talk about the U.S. today. This is the all milk price from January of 2000 through August of 2019, I think is the most recent month available. Pretty certain it's August. It's July or August. So this is not adjusted for inflation. This is in nominal dollars, and it's a lot of variation. If we took this graph back further into history, we would see that once we got back, earlier than the mid-90s, we wouldn't see nearly as much variation. We'd see a lot more. We'd see some seasonality in there, but not nearly these big turns. Where we have turns of $4, $5, $6 sometimes from month to month, or 2 months. Recently, so this is 2015, recently a lot less variation. But not all variation is bad. When you're at the bottom, variation's a good thing. You don't necessarily want no variation, because we can sit at these bottoms here and it's not so good. So it seemed like we've kind of been on a roller coaster here, right? Lots of up and downs, big turns that you've had to deal with, but fortunately some ups also. And the analogy that I want to use here is we don't not on the roller coaster in the last 4 or 5 years, we're on the tilt-a-whirl. Roller coasters can be fun because you go up and you go down and they can be fun. Tilt-a-whirls just make me sick. I don't know what you think, okay? And unfortunately, that's where we are today. We're on the tilt-a-whirl, not the roller coaster. We could use some coaster at this point. So this is income over feed cost. So this is USDA numbers, all milk, less their cost of their 16% dairy ration, which is a combination of the hay, soybean, and corn prices. And this is annual numbers, and this is adjusted for inflation, whereas the previous graph was not adjusted for inflation. So, it looks like a nice upward trend here, right? Flat lately, but you've got an upward trend there. But when we adjust for inflation, there isn't an upward trend. There's, in fact, downward trend, okay? Strong downward trend over this period with more. So this goes back to 85. These are annual numbers, as I said. More ups and downs in recent years. But adjusted for inflation, this income over feed cost has spent a lot of time in the last decade around that $4 range, which is not good. So part of the story here is we haven't accounted for production efficiency changes either, right? Because the average cow is producing a lot more milk here than they are back here. And so that's an important part of the story. But still, this is a strong downward trend. And that's kind of the world that we live in, where milk is a commodity for the most part, especially at the farm level. And so the efficiencies are driving things towards higher production per cow and more milk sold per farm. So what's going on with the stressed dairy farm profit margins the last 5 years? Okay, so 2014 was a good year. Since then, we haven't had a good year. Not one, okay? So low world milk prices relative to costs and trade issues affecting the prices, and trade issues, some of which were voluntarily kind of induced and some of which were involuntarily induced, as far as African swine fever, which has been a significant drag on milk prices in the last year. Okay? So it's not just the trade war. When China gets rid of 25% of their pigs, and they started off with 50% of the pigs in the world, and when you wean piglets, you use lactose and whey, right? So when they kill 100 million pigs, they need a lot less lactose and whey than they did before. So that's part of the story there. And the other thing is, in many parts of the country, you've got balancing capacity issues that have, the growth in milk production in some parts, like for example Michigan, has outstripped the balancing capacity there and led to milk having to go a long ways to find a home. Okay, and the farmers end up bearing that cost, and if you got an extra $2 of hauling costs on there, that's a big deal. Furthermore, if you're going to haul it that far, it's probably going to often get sold at distressed prices. Okay, so those kind of combination of things has led to these stressed margins. And, one of the things that's definitely happened in the last 15 years, if you look at U.S. milk production, you'll see that it was trending upward, but it's trended upward more steeply since 2004. And really, the big change there is that the U.S. Got competitive in the world markets and is now exporting a lot more milk, to the point where we're 15, 16% of milk solids that ends up getting exported. And that's a good thing in some ways, okay? We're not interfering with the milk price through the price support program. Really hadn't been relevant since the mid-90s for the most part. So now you've got market prices driving this, so we're exporting more. And the good news is that we can export some of that production growth. And one of the reasons we need to do that is we're short on butterfat. Actually, the whole world is pretty much short on butterfat right now, but we're long on solids, not fat. And they're joint products, right? You have some control over it, but you can't make one without the other. So what we've been doing is consuming the butterfat domestically, and in fact, sometimes needing to bring butter in. So if you look at butter consumption in the last 5 years, up about 5% a year. Margarine consumption down almost exactly the same amount. Also, more uses of creams in lots of different things. So that's been the success story. Meanwhile, what have we been exporting? We've been exporting milk powders, whey protein concentrates, and other things like that. So that's been a good thing, because that's been growing aggregate revenues, whereas they wouldn't necessarily have. in the other situation. Europe's got the same situation. Canada's got the same situation, where they, and that's part of the reason why they created that Class 7 was to try to encourage some of that solids not fat to exit the country, which made us kind of unhappy with them. But the other side of the coin is that when you have more exports, then you bring in more price volatility from other sources. So 20 years ago, if we wanted to talk about U.S. milk price outlook, we would just focus on domestic factors. Sure, we exported, but a lot of that was done with export subsidies. And so we were, for the most part, just dumping, although we wouldn't have wanted to call it that. Okay? So now we're competitive. We send lots of skim milk powder, non-fat dry milk, whey protein concentrates, and other things. We also export a decent amount of cheese. But that brings back the price volatility from some of those factors that are going on around the world, which sometimes are political, sometimes are weather-driven, sometimes, okay? And so you become, this becomes a factor. And by the way, if you look at our prices in the past 10 years or so, our milk powder prices are 93% correlated with world prices, whereas the cheese prices are only about 50% correlated. And butter is even less than that, because we're not exporting it. And it's good news, bad news. Okay, so let's talk about what this means for the farm. So financially viable farm, okay, in the short term, is going to need to have a positive net worth and liquidity and cash flow. And in the long term, you're going to have to be profitable. In an economic sense, profitable, and I'll get much more into detail on that. So key measures, profitability. So let's do a little review of your farm management class that you probably didn't want, but we'll do it anyway so that we're all on the same page. Okay? So the dimensions of farm financial health here, okay, is profitability, solvency, liquidity, and debt repayment is actually not a separate one. A debt repayment is actually a combination of profitability and liquidity, but I want to separate it out because that's what lenders are focusing on. Okay, so profitability is the ability to generate a positive net income. And unfortunately, not just in the dairy industry, but in U.S. agriculture in general, if you're producing commodities, there's unfortunately going to be years when you're probably not going to produce positive net farm income. And so the key is to make it through those times, and that's kind of what I want to talk about today. Solvency is having a positive equity position, so your assets exceed the value of your liabilities, because assets minus liabilities equals equity, which is also called net worth. Liquidity is having funds available to pay your bills as they come due. And capital debt repayment capacity is a measure that talks about how much of income you have available to pay on your debts that you currently have or that you might take out. So we'll get into that in a little more detail. So I'm at Cornell now. This is from the Cornell Dairy Farm Business Analysis Summary, which there's a couple, 250 farms a year in New York in this. They've been doing this for a long time. Jason Karzis is the person that runs this. He does a great job. This is the last 7 years that we have. So profitability, one measure is rate of return on assets, which is operating profit divided by farm asset value. So it's the value, the dollars of profit you're generating per dollar of farm assets that you have there, okay? A lot of businesses, the Walmarts of the world are going to want this to be above 15%. I'm going to tell you that you're not going to see that in agriculture because there's just a lot more capital invested per dollar of sales and therefore dollar of profits. So long-term, well, I'll show you a long-term number in a minute. But so if we look at this, you've got 2014, which was a very profitable year. That also shows up in the Wisconsin and the Michigan numbers that I'm familiar with because I work with all three of those. And then we have this period here of, 2017 was 3.6. That's about half of what we would want to see in an average year. Because the average year over a long term, if you look at these numbers, is 6 to 7% rate of return on assets with a lot of variation. So we haven't had a number that's approached average. And in 2019, is it going to be much better? Probably not. It's not going to be average, unfortunately. So that's profitability. Debt to asset ratio is a measure of solvency. So that's just literally the dollars of debt divided by the farm assets that are being used there. This number is, actually, that's a pretty decent increase. Remember, this is averaged across 250 farms. So some of them have definitely taken on a lot more debt to have this increase by 5 percentage points. Long term, if you look at these numbers, and it's true across kind of all commercial agriculture, the debt to asset ratio tends to be right around 30%. That's the USDA numbers, that's the numbers for the dairy farms, that's the numbers for the crop farms that I've worked with for the last 20 years. And that's not a bad thing to have some debt, right? If you can utilize the debt to generate more income than what you're paying on the debt, then that's a good thing. And debt has tax implications that help you out. And so, that's kind of a long term. But there's a lot of variation going on behind these numbers, right? If you just expanded, your debt to asset ratio might be a lot higher. Earlier in your career, when you're buying in, it's probably a lot higher. And as you approach the end of your career, you probably want that number to be much lower, okay? And this is liquidity. This is the current ratio, which is the value of current farm assets divided by the value of current farm liabilities. So current farm assets are things like cash, market livestock, inventories, prepaids. They're things that are easily, or expected to be converted to cash or used in the next year. Versus current farm liabilities are things like operating loans, accounts payable, but also the portion of the longer term debt that's due in the next year. So the higher number here means you've got, so this 2.46 would mean that $2.46 of current farm assets for every dollar of current farm liabilities. Because of the lender's approach in the last few years, they have wanted to see more liquidity in farms, and you've seen farms trying to hold more liquidity over that time. And most lenders will want to see that current ratio be above 2. Higher is better, but you also, if you're a farmer, you don't want to hold too much liquidity because that's money that you could be doing something else with. You could be investing it in something long term. So you don't want to hold too much liquidity either. But, and so this number trends downward, but not as much as I think you'd see on the average farm. These are some numbers from the Michigan Dairy Farm Business Analysis that I actually moved to Cornell only a few months ago, so I spent about 20 years doing this analysis. So I'm pretty familiar with these numbers, and this is just a similar set of numbers. And I like to put too many things on the slide for you guys to be able to see from the back. So can you read that? Okay. Well, then you have better eyes than I do. So this is milk price received. So this is about 125 to 150 farms, depending on the year, in Michigan. So it's less farms than the Cornell one, but there's also less farms in Michigan. There's about 4,000 dairy farms in New York, and right now we're below 1,500 dairy farms in Michigan. And actually, if it keeps going out at 13% like they did last year, we'll be a lot less than that, unfortunately. So, so here's the other thing to remember when I show you these numbers. These are not randomly selected farms. In order to be in this, they have to have produced an accrual adjusted income statement and a balance sheet. And the balance sheet and income statement need to meet the standards, which means that we go through and check them to see whether they reconcile and make sense. And if they don't, we don't use them. So we have a selection bias on these farms. So also there's a lot of variation going on with these farms, and I'm giving you averages. So there's a selection bias, but I would argue if you're going to benchmark, you should benchmark against the better managed farms, and these tend to be that. And so that's what's going on here. But this goes back to 06. So here's the milk price received. Keep in mind, in 06, we had corn that was more like 2 1/4. So it was fundamentally different deal, milking cows back in 06 than it is when corn is 350, okay? This is rate of return on equity, rate of return on assets, which these are both measures of profitability. And they're going to be highly correlated, and the relationship between the two is going to depend on whether you were using the debt that you had to generate more income than you were paying in interest payments. But let's focus on rate of return on assets here. And then I'll come back to this in a minute. But so rate of return on assets, again, long term about 7% average if you go back to 1995, about 7% average on these Michigan farms. The good years for profitability are in green. The kind of average years are in black. And the bad years are in red. And the bad years are pretty much all recently. Okay? So this is, this negative 0.1 means that you milked cows all year long and paid for the right to do it, unfortunately. okay, which is sad. Okay, but so we're looking at some pretty low numbers, which are largely driven by the operating profit margin being negative. So I'll come back to that. So profit, what does it mean to be profitable? Well, you've got to have adequate returns to the ownership, to the unpaid labor management and capital. Okay, and long term, you got to be profitable, or you should probably be doing something else with your labor management and capital. Okay, so when economists think about cost of production, we put in some returns for the unpaid labor management and capital, at least the opportunity cost, which is what you could be doing with that if you didn't have it invested in farming. Okay, so when we deal with these farm numbers, we will put in value of unpaid labor and management, usually by working with the farm to figure out what they think that's worth, although I will tell you that we will sometimes put it in at the value above what they tell us it is, because farmers tend to undervalue themselves. Okay, and you'll also see that family draw is something that if you get into these reports, you'll see, the first thing that gets adjusted when you have a bad year is family draw. Right? You start looking at it, you'll notice if it's a bad year that there'll be a lot less depreciation because there was a lot less investment in new things. You'll see oftentimes repairs go up in a bad year because instead of buying new, you're making do with what you've got, and then family draw can vary a lot depending on how the year was. So rate of return on assets, I already talked about what that was. This is rate of return on assets over time for 3 states, which is Wisconsin, Michigan, and New York. Because I work with Jason Karsis and Wayne Knoblaw in New York. I had been doing them in Michigan, and Mark Stevenson, Center for Dairy Profitability at the University of Wisconsin. We collaborate together and look at these things together. So this is for 3 states, and it's the same pattern graphically that you basically saw with the Cornell and the Michigan state numbers, which is, so again, you've got a long-term average over those 3 states is actually more like 6. And you can see good years, bad years, good years, bad years, and then 4 bad years. It's 2009, right? That's the Great Recession. That's milk prices dropping by 50% and feed prices dropping by 12%. And dairy farmers basically having to eat the difference. And we had kind of hoped that that was a one-time thing. And it was as far as a recession, but it wasn't as far as, these returns, which are essentially basically zero last year across these 3. And so this is almost 500, it's more than 500 farms across the 3 states here. So this is rate of return on assets, which again is operating profit divided by asset value that's invested. We can break that down further into operating profit margin and asset turnover, okay? So, which is useful if you want to get at what's driving the low profits. So operating profit, again here, net farm income, add back in interest expense because we don't care how you financed it, minus the unpaids divided by the gross revenue that you generate. So it's the percent of profit earned per dollar of sales, okay? So operating profit margin is dollars of profit per dollar of sales, and asset turnover is dollars of sales divided by the dollars of assets, okay? So, yes, sir.
In your analysis, is farmland considered an asset?
Yes.
It is. Okay.
Mm-hmm.
That's market value.
Yes, sir. So the question was, is farmland considered an asset? And the answer is yes, and I will tell you, but we adjust, so over time, and you can look at measures on these summaries, and they'll show you earnings without appreciation of value, okay? So we break it out that way. The other thing is we put a cap on how much we let farmland values change from year to year. So if somebody had it on their books that the land was worth $1,200 an acre, they can't suddenly look around and go, well, geez, it's worth $4,000. Okay, that would be completely misleading, and we wouldn't let that happen in our analysis. So we're trying to adjust these gradually over time when they happen. But we do want it, and the other thing is, I'm only talking about ROA at market. We also report ROA at cost. Okay, so you can have cost values, and they're reported in these summaries. But you need to be careful with costs, because if you're going to compare across farms and over time, ROA at cost can be very misleading. What I'm talking about is valuing the assets at cost as opposed to current market value. And so if you have a farm that was purchased 50 years ago, the cost value is still what they paid for it 50 years ago. Not terribly accurate, right? So the other thing you'll see is that farm values, especially in the upper Midwest, go up on average about 6% a year. Okay? It's not necessarily 6% from one year to the next. Sometimes it's going to go up by more than that. Sometimes it's going to be less. But if you look at over the last 25, 30 years, the average is 6% for farmland values, which means, by the way, that farmland values at that are going to double in value every 12 years. Okay, rule of 72, right? Divide 72 by 6, you got 12. So, and that's been a good thing, right? So owning land has been a good thing, which it has to be, because for many U.S. farmers, the appreciation in the asset value, which is mostly land, is their retirement plan, whether they've consciously done that or not. So, but going back to this, if we define these this way, then the rate of return on assets is operating profit margin times asset turnover, which is DuPont analysis, and we could actually do a slightly different DuPont analysis for ROE. But what this is operating profit margin is earns, and this is turns. So this is how much you're earning per dollar of sales. That's operating profit margin. Asset turnover is how many dollars of sales you're generating per dollar of assets. And the reason that this exercise is useful is if your rate of return on assets is low, and really, I mean relative to peer farms, okay? And that's one of the uses of having these farm business analysis summaries is hopefully you can benchmark performance to peer farms. Because you'll see there's definitely an industry effect. When we have a bad year, everybody has a bad year to some extent. Some have worse. If operating profit margin is low, that's the earns, then that means that you're not generating as much dollars of profit per dollar of sales as you should. Probably that's a cost issue, unless there's something going on with your milk price. Okay? And by the way, these are all specialized dairy farms, which means that the dairy enterprise has to produce at least 75% of the income on the farm, which is not actually which isn't just milk, right? It's a dairy enterprise. So it's cull cows, it's calves, it's co-op dividends altogether. But honestly, that's not difficult. Most dairy farms are specialized in milking cows. So if this is low, you probably have a cost issue and need to dig more in there. And if asset turnovers is low, then that means you're not generating enough dollars of sales per dollar of assets, and probably your lender would say that you have some debt or unproductive assets. So maybe you go back and look at whether you're overcapitalized on the asset value. If we look at those three states, Wisconsin, Michigan, and New York, over time, these are the average asset turnover and operating profit margin values over from 2000 to 2016, which is the most recent period that I have all three states for. You always have a higher asset turnover value than you do operating profit margin. And again, it's this times this that gets you your profit, your profitability, your rate of return on assets. Negative operating profit margin in 2009. Lots more variation. 2/3 of the variation that's going on here to 3/4 of the variation is going to be driven by the operating profit margin, which is what you'd expect in a market where it's largely driven by cost efficiencies. Okay? So management implications then of kind of what we've been talking about so far is, farmers need the ability to deal potentially with longer downturns than what we had been seeing. Okay, so managing through if we're in a boom or bust industry at the farm level in the last 25 years in the U.S. dairy industry, and that can work okay as long as the booms come along at a reasonable rate. I think one has to be careful about the so-called 3-year cycle, because if you are managing expecting every third year to be good, then you've been in a world of hurt here. Well, you have anyway, even if you weren't managing that way. But the expectation, okay, I think can lead to some poor management decisions, so one has to be careful there. You need to maintain access to outside capital because of operating loans, the potential to expand, and just because some of the things that you're going to want to invest in, maybe labor-saving technology, because if you walk around this show here, it's just astounding to me. Robotic milkers and robotic feed pushers, and which are really cool. And actually, I was on somebody's farm a few months ago, and he had a robotic pusher, and he said that, I don't know, it wasn't programmed right or something. The end of the barn was open. When they first turned it on, it just went and left, and they had to chase it down the lane to get it back. So then I guess they got it programmed right. Looks like just a big Roomba, right? Okay, I think it's important to assess the business strengths and weaknesses. If you're going to be in a commodity market and that's the model you're in, then you've got to be one of the low cost. You have to be. That's just the reality. Okay? And by the way, interesting thing about the U.S. dairy industry is how much heterogeneity or variation there still is in farms. Okay? That's one of the reasons it's fun to work on dairy stuff as opposed to some of the other commodities that we produce in this country, because there's still lots of variation in farm size and the way people do things. Okay? And so you don't have to be the low-cost person. And lots of people do specialty things, genetics and other things that help them get by. But if you're going to be in the model of the low cost, then you're going to be constantly looking at this. And lots of dairy farmers are very good at that. And then I'll talk more about this, but you want to consider risk management that's going to work. So what I'm going to suggest here today is that a farm financial goal for everybody, not just the dairy industry, but we're talking about the dairy industry, is to be a resilient business. Okay? And that you should do things that are associated with building resiliency of your farm business. And, okay? So resilience in general is how you respond to shocks and disturbances, which is to say the elasticity. How far down do these disturbances, these negative disturbances, push you when they happen? And then how quickly do you recover when you come out of it? Because we will have good milk price years again. That will happen. How quickly do you recover when you come out of it? Okay, so your ability to anticipate, prepare for, respond, and recover from a shock. And we've had a lot of shocks. I mean, part of it is, I hate the analogy The Perfect Storm because it's been so overused, and it wasn't that good a movie. But it's, you know, relative to 2014, milk prices are down, feed costs are not, really. Cull cow prices, they were about a fourth of what they were in 2014. I don't know where they are right now. And calves are not worth anything. Okay? And if you were depending on a crop enterprise, that's not helping either. Right? I mean, you need a crop enterprise anyway because, frankly, forages pay all the time for dairy farms. But the grains don't right now. We had a period from 1985 to 2006 where 9 years out of 10, it didn't pay to grow your own grains. You'd have been better off taking your land, renting it to the neighbor, and buying the grain back from him at harvest. And then we had a period from 2007 to 2014 where that was definitely not true. But we are now, U.S. farmers are really good at adjusting their supply upward to meet market demand and driving the prices down to long-term costs. You guys are just way too good at that. So how do you measure farm financial resiliency? Think about how much equity or liquidity that you can afford to lose from where you're at. How much gets lost in bad years, and how long does it take to recover from those losses? So you need to measure your solvency position and your trends relative to lender benchmarks, okay? Because it isn't so much where you're at as far as debt to asset ratio. It's where you're at relative to what your kind of lender thinks for maintaining access to affordable capital. Liquidity, same thing. More liquidity is better up to a certain point. We want that current ratio above 2. Very few people are there now. Came out of 2014 with a lot of liquidity. And then, unfortunately, by the end of 2015, it was mostly gone. And it just hasn't recovered. And you want to benchmark it to similar farms for profitability over a 3 to 5 year period. And I'll show you why a little bit later. So let's just talk about access to capital. So a resilient farm maintains access to outside capital from lenders. Okay? At some point, you're going to buy something and probably not have enough money under the mattress because things are expensive. Just walk around here, right? And so you need to make long-term investments, and you're not going to do it all from your own money. So, but think about it from the lender's point of view. Lending, just in general, is about risk management from their point of view. That's what lending is. You're trading off risk and reward, right? So you're always assessing how risky is it for me to lend this money. That's always what they're asking. Okay? So what they're concerned about is probability of default. And every lender has a model for probability of default. Okay? And when you go borrow money, they probably have you update your balance sheet. They might have you do a profit and loss or some sort of income type statement, and they're tracking that over time, and they're watching these trends, and they're trying to decide how to assess probability of default, which is going to be some function of farm profitability, liquidity, and solvency, and capital debt repayment. And then there's going to be some term that they have in there for wiggle room because they, will, if they have a long-term relationship with you and they really like the family farm model, then, or their business model or something, then they might give you a little, if you're on the edge, they might give you a little more favorable. But they're always tracking this. And that's how they're deciding how to rate you. So you all, we all have a FICO credit score, and every dairy farmer has a probability default score with their lender. You all do. So there was a time when all the lenders basically looked at was solvency position. So debt to asset, your equity position. But the 1980s changed that fundamentally. Right? So we came into the 1980s. Remember, we came out of the 70s with lots of inflation, just in general. Prices were high, inflation was high. That was, after the 70s was, plant fence row to fence row. We're going to be in the world markets, especially on the grain side. Started exporting heavily to the Soviet Union and other places. And so there was lots of appreciation in farmland values following this kind of boom. And then in the late 70s, then inflation just in general got too high. And the way the Fed takes care of high inflation is they crank up interest rates, right? So we actually had a recession in the early 80s that was caused intentionally by the Federal Reserve because they were trying to get inflation under control. So it's amazing to me when I look at the farm records, because I was around in the 80s, but I wasn't paying much attention to this stuff beyond our farm. But there were mortgages on farmland 25, 30 years at 15, 16, 18%. Okay? That's credit card interest rates today. Imagine buying farmland at 18% interest. Just amazing when you think about it now. And actually, the people that are undergrads in college now just can't get their heads around that when you show them the numbers, okay? Because that's what, if you're high risk and you go apply to Visa, that they're going to charge you, okay? So, but what happened was farmland values went from $2,500 an acre average U.S. value to, in about a year and a half's time, $1,200 an acre. Okay, so all of those balance sheets that looked really good at $2,500 were now gone. Okay, and the lenders discovered that just tracking solvency, and I don't mean to be too hard on lenders, they were also tracking other things, but they were largely focused on solvency, that didn't work. So today they focus on debt repayment capacity, which is a combination of profitability and liquidity. Okay, and the critical threshold for their debt to asset ratio that they're looking at has been declining as they see more risk in the market. So there was a time when if you were below, and the reason that this threshold is important, okay, is that when you get above that threshold for debt to asset, or if we did the inverse, which is equity to asset, which is just going to be 1 minus this, 100% minus this, when you get above that threshold for debt to asset, then the first thing that happens is your interest rates go up because they're going to put a risk premium in there, okay? And if you're talking about interest rates going up 1% over what they would have been otherwise, that's a huge difference in cost in a term debt. Okay, that's a 15% increase, 10 to 20% increase depending on what your base interest rate is. Okay, that's a big difference. And the second thing that happens if you get too far above these thresholds is that they cut you off. Okay? So how much can you afford to lose is an exercise that everybody needs to think about, I would suggest. So if you want to stay above that, you get your balance sheet, you track it over time, you see where you're at for debt to equity or, debt to asset or equity to asset, which are just complements of each other. And you see, like, what are we talking about here? If I'm at 40% debt to asset, like how much equity would I need to lose to where I get to where I'm 50%? And I'm starting to get concerned. And this doesn't tell you, by the way, what to do. It doesn't tell you what to do, but it does tell you whether you need to be paying attention to it or not. Okay? When you're tracking these financial measures, they don't give you an answer of what you should do. They do say how much risk you have currently and whether you should be paying more attention to this. So equity to asset, we see lots of ups and downs, although this is only, these are 2 to 4% ranges for the most part in the data that we have. But that's a lot of money when you're talking about dairy farms that have often $4, $5, $6 million in equity. 2% is a lot. That starts being a significant amount of money. And the lenders look at debt repayment measures. By the way, I'm happy to share the slides with anybody that wants them. If you send me an email, I'll send you the slides. I'm happy to. but you're also welcome to record it. I don't care. So I just want to let you know, because it looks like a lot of work holding that up there all the time. Which basically is your net farm income plus depreciation, which is because it's a non-cash expense, plus any non-farm income, minus your interest, minus family living, and income taxes, and then divide that by your scheduled principal and interest payments. And lenders want to see this term debt coverage be above 115, so 15% above. And you know, if you have more non-farm income, then your ability to pay debts goes up. But is that really what you wanted to spend your non-farm income on? So this is what lenders are tracking. In term debt coverage, also you see some volatility over time here. The last year that I have all three states on this, unfortunately, is 2015, but it was definitely headed in the wrong direction and hasn't gone up since. This is percent change in the current ratio. You see a lot bigger changes. So here's the chewing up of the liquidity in more recent years. Cash flow problems. Well, there's some cash flow problems that are unavoidable. If the whole industry is hurting, then you probably can't do much about it. But you know, as a farm business management person, I have to tell you, if you do cash flow budgeting, then that's probably going to help you see problems as they're coming. Setting priorities for liquidity. You know, we are going to come out of this. I think there's more upside in the milk price markets than what the futures market currently sees at this point in time. I hope I'm right. We'll see. You know, the first thing that's going to happen, I think, for a lot of farms is they're going to want to get current on their debts. And then you've got to start making up some of the maintenance and repairs that you've been putting off for the last 4 years. And then, you know, the investment needs to depend on the farm goals as far as, and that would, I would argue, if you knew what your cost of production and your financial position were, that might help you set some of these goals. So you want to definitely invest in things that generate revenue if you can. And maybe our weaknesses, like maybe depending on your labor cost, for example, you might want to think about labor-saving technologies. I will tell you, looking at farm financial records over the last 25 years, the biggest single indicator of dairy farm profitability is labor cost. And I mean total labor cost, so accounting for family unpaid labor, okay? If you do that, that's the single biggest factor correlated with dairy farm profitability. It's not feed. Feed cost is the biggest cost, but that's a lot more common over time, although, to be fair, not accounting for the quality of the feed and, you know, things like that, because I can't do that from the financial data. So if you look at the three states over the 17-year period here, the average loss in liquidity in bad years is about 12%. Average gain in good years is 16%. So that's good if you're average. That means maybe you can make it back up if we ever get a good year. An average, this is equity to asset, which is just the complement of the debt to asset. So higher equity to asset would be better. And again, that's pretty symmetric, but unfortunately a little bit worse in bad years than it is in good years. And here's some maximum numbers as far as the worst years that we saw. Maximum loss of 40% of liquidity, and maximum of 10% across these farms for liquidity and solvency. So that's kind of how bad you're looking at it being. And then if you do have an accrual-adjusted farm income statement and balance sheets that you keep up every year, then you can benchmark against similar farms, which is something that I would argue would be effective in helping you assess the farm business and where the strengths and weaknesses are. And you're going to want to compare to similar farms. And if you look at the farm business analysis summaries that the University of Wisconsin, Cornell, Michigan State generate, if you're a crop farmer, then Illinois, Minnesota. Minnesota's also got some dairy farm ones that you could compare to. Some accounting firms, if you participate with them, will probably generate benchmark reports for you to compare to. You should keep in mind, by the way, that the university ones, we follow Farm Financial Standards Council, and the accounting firms generally do GAAP, which is their accounting practices, and so they're slightly different on some things. So that's something to keep in mind. But you want to compare to similar sized farms, and the farm business analysis summaries, we break it out by farm size. Okay, so, and this just says if you're going to benchmark profitability, you want more. This is percent of the farms that were correctly benchmarked into their appropriate quartile. And if you only had 1 year, you only got it right about 50% of the time. And if you had 5 years, you got it right about 3/4 of the time. So what that means is you want to benchmark over a 3 to 5 year period, okay? Because any 1 year could be an So, farm financial risk management. Let me just finish up by talking a little bit about risk management. So risk management for farms, and of course we can get into the specifics about how to use futures and options and things like that, but I'm not going to do that today. So let me just say in general that the key is making sound investments, okay? Investment decisions in long-term assets, when you invest, how much, in what, those drive kind of long-term farm risk, okay? And so you want to invest in things that are going to generate the revenues to pay for themselves, and you need to account for the fact that you're going to have cash flow, liquidity issues that are generated by external shocks. When you're thinking about risk management tools broadly fall into three categories. They either reduce the variability of outcome, they maintain decision-making flexibility, or they improve the risk-bearing capacity of the farm business. So reducing income variability, that's things like futures and options, insurance contracts, things like that, forward contracts. Diversification in general will reduce variability sometimes depending on what enterprises you're combining, but you, of course, have probably noticed that there's some trade-off here between economies of size and diversification, right? There's a reason why farms have tended to specialize in certain things like milking cows and let some of the other enterprises go, and they've done so to try to achieve some of the cost savings that are associated with economies of size, which you generally find in milking cows relative to labor and capital investment. Maintaining decision flexibility has to do with the option value on some of your decisions, investing in things that give you some flexibility in how you're going to use it. Improving risk-bearing capability, that's where you want to have the access to the outside credit. Okay? So setting price risk management goals, let me just finish up with this. I'm going to suggest that you all need to have some idea of what your cost of production is. Which is not an easy thing to calculate if you're going to do it accurately. Okay, so if you don't measure it, you can't manage it. Don't use your Schedule F to calculate your cost of production. Or if you start with Schedule F, that better just be the starting point, and you better do a lot of adjusting, because your Schedule F cost of production is going to be off by 25% or more. Versus your actual cost of production, because it's completely a cash thing. Mostly because it's a cash thing. Okay? And over the long term, you've got to cover your economic costs. This is from a survey we did nationwide a few years back, reasons that dairy farmers don't use risk management tools. The biggest one was lack of knowledge, and then lack of time was also important, which I would put together for most dairy farms. I'm not suggesting that you need to do risk management, although you're all doing it every day, by the way, in some sense or form, right? Because a herd health program is risk management. Okay? This is from a different survey where we surveyed farms nationwide, and we asked them how they allocated their management time. And they had different ways of breaking it out. So this was farms that were single proprietors that had there was a farm family, but there was a primary manager that made the management decisions. And this was one that was combinations of management teams, okay, multiple primary operators. And you would expect, of course, that they would allocate their time a little bit differently. But the point here is, if you're the single one, you've got to focus more on the production issues. You don't have as much time to focus on things like the finance, risk, and marketing decisions. Whereas if you're part of a team, then one of the benefits of that is you can kind of specialize in who takes care of what. The downside is you've all got to get along on that, right? But you can kind of specialize in where you're allocating your time. And I'm not saying, by the way, that one is better than the other. I'm saying this is how the management time gets allocated. So we've kind of toured a lot of different things, but I think the important conclusions here are that unfortunately, we're not going to leave the era anytime soon where you've got to have the ability to manage through the bust periods, as well as the booms and the busts. This one's been a pretty long bust. Hopefully it's an anomaly, but I don't know that we can plan on that. So I want you to consider the resiliency of your farm business as measured by your current financial position, your risk management activities that you take on, like maintaining access to outside capital and things of that nature. Understanding and managing cost of production. We could spend a whole day just talking about how we calculate, measure, and use cost of production. But I think it's increasingly important that you do that and you compare it to kind of figure out where your strengths and weaknesses are, compare it to other similar farms, and think about areas where you might improve it. Benchmark your financial performance over many years and use that to hopefully key some of the decisions. This is not a fun period to be doing financial analysis, okay? It's kind of like going to the doctor when you're afraid of what it might be. And so I completely understand that. But you know, this is actually the most important time to be tracking how you're doing financially, because understanding your solvency and liquidity position doesn't tell you what you should do, but it does tell you what your risk position is and how much wiggle room you have. And I would argue the closer you get to those thresholds, like for example where the lender capital gets more expensive, the more important it is you be considering risk management decisions. And then risk management, the key, and we could again talk for a whole day about this, but the key is to have reasonable goals for what you're doing with the risk management program. The risk management program is probably not going to be a profit enterprise over the long term. Okay? You can't take out the valleys in milk price without taking some of the peaks out. If you can just take out the valleys and not take out the peaks, stop milking cows and play the market. Okay? Because that'd be easier. But that's not going to happen over the long term. So the key is to set reasonable goals and then to have a consistent risk management program, okay? If you look 12 to 18 months out, every year in the last 4 years, there have been costs that have been $1 or more higher than where we've ended up. And you don't want all your milk locked in, but there have been opportunities in that 12 to 18 month out period every year for the last 4 years. And if you had 30% of it locked in, then you probably were pretty happy about that, okay? But that's something that you have to look at relative to your management abilities, what keeps you awake at night, what your goals are, things like that. So, thanks.
Thank you, Chris, for your presentation. Does anybody have any questions? Way in the back here.
Dr. Wolf, in these times, would you recommend farmers diversifying their operation in order to take on something, if possible, that has a very high return on investment? Specifically, I'm going towards the hemp industry. That's where I'm going.
Well, you know what? I think that diversification, depending on the management team's ability and desires, and depending on your land base and your geography and your proximity to things like that, that can be a good thing. I mean, I would say this. The biggest constraint that every farm manager, in fact everybody has, is their time, right?
Yes.
So how does operating this other enterprise work with your current management abilities and the timing? Like, is planting and harvesting at a good time to not, have the last thing you need is another thing added on when it's corn silage time, right? So I don't know about the timing of that, and I will tell you this, I understand very little about the hemp industry, although I was talking to somebody a couple weeks ago and they were telling me that if the THC number is above a certain value, that it gets destroyed. And they had some data that suggested that about 25% of the time it was above that number, which I found absolutely, that's
Yes.
a risk.
Yes, you are 100% correct. There's a lot of wild things that are going out in the hemp industry, especially here in Wisconsin. And that's why I'm part of a team that is very, very precise in planning operations from planting the seed to the oil that's going to be in the retail space. Okay. And that was what guarantees success. I'm part of a team of people who have been in the industry for 20-something years. And so I'm just here to offer my service. I'm a real estate agent But like I said, I'm part of a team. So if you have any interest in diversifying your production and getting into the industry at this point in time, I will give you my card and we can have a conversation.
There's a couple here. Yes, sir.
Yeah, Doc. As a financial institution that we belong to, took on risk more than they should have, is it time to look for another bank?
Well, I mean, that's, you know what? I guess it depends on how it's coming through to you as far as, does that mean that they're having to charge higher interest rates than their competitors because of that? Well, you know, I think if you're talking about long-term debt, right, it doesn't, if you start calculating how much you're paying in interest over a 15 to 30-year period, you need to get the most competitive loan that you can. I would say that's probably something that you need to look at. Yes, sir.
Being from out of state, but receiving a local newspaper, sees periodically items about the, I guess it's particularly in the northern half of Wisconsin, dairy farms filing for bankruptcy. And I assume that's kind of at the extreme of the situation, but could you explain a little bit about your comment on those news items?
So, about farms exiting?
Bankruptcy.
Okay, well,
Proceedings.
oh.
Filing for bankruptcy.
Well, okay, that's a good question. So, relative to, it's definitely true that farm bankruptcies are up, and that has been in the news some, and my sense is that that is correlated with the farm stress and some indicator of what's going on at the farm, but vastly understates the problem because a lot of farms are going to exit and not file for bankruptcy. And so, you know, I don't know that that's a good proxy, but it's definitely correlated. I will tell you that last year in the state of Michigan, over 13% of licensed herds exited the business. And in a lot of other states, in Wisconsin, I think it approached 10, and some other states, you know, the long-term herds exiting is around 4%. It's a little bit higher than 4% because we've been higher in recent years, but a 4% farms exiting would indicate, you know, that kind of makes sense with generational change in the sense that if you thought the generation is 25 years, but it's definitely higher. But one thing that I personally have thought about the bankruptcies is that they kind of vastly understate the problem because there's a lot of farms that are not pursuing that avenue because it works for certain situations, right? But it doesn't work for everyone. But it's a good question.
So I have one more question. Dairy producers often joke that, and especially at the World Dairy Expo, if I implemented all of these things, I'd be at 200 pounds of milk per cow, right? Because they're all telling me it's going to do this and this. What would be a rule of thumb as a manager of a dairy of what my return, if something's going to cost me 20 cents to implement it, what should my return be? Is that a fair question?
Yeah, well, it's a fair question, and it might not surprise you that an economist says it depends. Well, it should in the long term be above 20 cents. I mean, we could do a whole seminar on analyzing investments, and you know, I think that, for example, if we were talking about an operational change like feed issue, then I would recommend sitting down and going through kind of a partial budgeting exercise where you look at how much it's going to cost you as far as increased costs and potentially decreased revenues, if there are any, compared to decreased costs and increased revenues. And in doing that kind of reasonably, looking at do we expect this to have a return, and then if it was a longer term investment, then what I would say is do a net present value calculation, or what an economist would call a capital budget, where you look at the projected cash flows with and without your potential change that you're talking about and look for a positive return over time. So, you know, what does it take? Kind of depends on how much risk is involved, how much liquidity it requires, right? What your cost of capital is on whatever change you're talking about. So, you know, I hate to be the economist, but it depends.
So on that note, 5 to 7 years, is that still the rule of thumb?
As far as payback,
Yeah.
I don't like payback period as a measure. I think it's okay to look at payback period if you also look at net present value or internal rate of return on the investment. The problem that I have with payback period is it's purely a liquidity measure, and it doesn't look at the long term what happens to the cash flows. So, but the more liquidity constrained you are, the more important the payback period is. That's true. But
So-
I would say payback as part of a bigger analysis is okay.